Shall we go? Yeah. Okay. Good afternoon, everyone, and thank you for joining us for today's webinar on industrial and logistic real estate in Belgium and in the Netherlands. My name is David Vermeesch. I'm a managing partner at Colliers Belgium, and I'm honored to moderate today this traditional webinar jointly organized with our partner MSCI. This edition of our webinar is slightly different from previous edition. This time, we are going to focus our attention only on one asset class, the industrial and logistic sector, a crucial and evolving asset class for both countries, Belgium and the Netherlands. Given the strong cross-border dynamics in this region, it seemed to us especially relevant to address these markets side by side. After all, many investors and logistic providers view these countries as one integrated market. Today's session is even more exciting with the participation of Jo de Wolf, CEO of Montea, whose vision and expertise in logistics in Belgium and the Netherlands, but also, if I'm not wrong, in France and in Germany, will provide real-world insight into the sector. Jo, thank you for joining us today. Now, let's dive straight into this hot topic. With logistics increasingly central to modern economies, understanding the forces shaping real estate in this sector is critical, from the impacts of technological evolutions to the urgent need for sustainable energy solutions. The landscape has become more complex and more competitive. Last mile or final mile, how do we manage the most complex and troublesome segment of the supply chain? Where does the market stand 4 years after the COVID-19 boom? And what challenges do we face in addressing these demands amid land scarcity and energy pressures? Not speaking about intermodality or just mobility. These are just some of the issues we will explore during today's session. And we are thrilled to have a panel of experts who will bring us up to speed on these issues and more. Here is our agenda for today. First of all, Maarten Broek, Executive Director at MSCI, will open with a broad view of logistic trends across Belgium and the Netherlands. Maarten will be followed by Madeleine Buys, Head of Research at Colliers Netherlands, based in Amsterdam. Madeleine will offer a closer look at the Dutch market with emphasis on key contrasts and common trends. Afterwards, Madeleine will be followed by Petar Timotic from Colliers Belgium Capital Markets team, and Petar will provide insight into the Belgian market and covering emerging opportunities and unique challenges in Belgium. And finally, Jo de Wolf, CEO of Montea, will share his view on his company's strategy and geographic focus in the logistics space. We'll conclude with a dynamic panel discussion, and we encourage you to submit your questions via the chat throughout the session. Our speakers will answer as many as possible of your questions during our discussion. Thank you once again for joining us. Without further ado, let's get started. Please join me in welcoming Maarten Broek to the virtual stage for his introduction to the logistic market in Belgium and the Netherlands.
Thank you, David. Thank you for that introduction. Let me show. Can you hear me?
Yes.
Good. Let me kick off. I must admit the share screen is not working as it was a minute ago. But yeah, thanks for having me here today. And I'd like to go through with you on a number of the topics that you just raised. Once again, I am really struggling to. Is there some technical support I can get? It's a little bit silly, but if anyone else can share my PDF, then we can start talking, because I was going to start with some good news.
Okay.
There we go.
Saved
by the bell. Let's get going.
Okay. Super, Martin. We are all ears.
Good, good. As said, I was going to start with some good news and wanting to put Netherlands and Belgium in a long-term perspective together with the other European countries. So what we're seeing here is total returns as measured as part of our European Annual Property Index across the last 10 years. So not just focusing yet on the last 2 years, where obviously things have fared not so well, but just looking at the long-term trend. And here you can see for Netherlands, we have recorded a 9.2% annualized return over the last 10 years. And for Belgium, we have realized a return of even 9.9%. And we can see that both of the industrial markets sit in the middle of the pack with these returns. But we can also very much see that obviously these returns are quite good. And very much a result of the popularity and income growth in the asset class. And yeah, I think that's I think what has driven a lot of the interest in the sector. And so if we move on, what's interesting to see is that because of the interest in the sector, and maybe well, we can argue what was first, the interest or the exposures, but we've really seen the allocations to the industrial sector increase. So on the left here, we're seeing the same annual property index I just referred, and we can see that in 2001 there was only 8% of industrial in that index, whereas at the end of 2023 we were recording 15%. And at the same time, you can see that the interest in retail and office has decreased. So retail and office exposures were lower every year. Industrial has grown, but at the same time, we've also seen residential and the other sectors grow, and particularly the alternatives also have gained a lot of interest. What's interesting here is on the right side, we're also looking at our pan-European property fund index. And why that's interesting is because those are the funds that had the most capital to deploy over the last, say, 10 years. And there you can see that the interest in the industrial sector was even bigger. So we started with 13% only in 2007. And because those funds had the capital to deploy over the last 5 to 10 years, you can see that they've really chosen the sectors of their favor. And you can see that we now have a stellar 31% of industrial assets in that index. And I think that really shows how much parties wanted to get into the market. Now, I say chicken and egg because we've seen these good returns. Obviously, the good returns also have been driven by yield compression, as we'll see later on, and obviously the interest there was also the cause of price increases. But yeah, we've seen a clear clubbing into the industrial sector from a European perspective, and Netherlands and Belgium are no different there. As I said, over 10 years, it looks really good, but industrial hasn't been immune to the interest rate increase we've seen coming through in the market in 2022. And so what we're looking at here is the development of the values of the industrial sector as we measure them across these 5 markets, including Netherlands and Belgium. And there you can see that both Netherlands and Belgium have taken a hit of between 15 and 20% to values. But keep in mind, we've seen these very high returns on the long term. The upswing before June 2022 was also quite impressive, and that is why I think the market has cooled down a little bit. And you can see the UK line there is even lower, but also there I think the market was even booming more in the years going up to June 2022. But nevertheless, yeah, the interest rate increase hasn't missed the sector either. And to put that in some perspective, I mean, what we see typically when a crisis hits the real estate market is that investors start sitting on their hands. So investors stop investing or stop buying and stop selling, waiting for price price discovery to emerge, and anyone who can choose to, or anyone that can choose, will not trade, but probably wait it out and see where we land. And so what you see here on the left is the all sectors transaction volumes that we measure, and that's a global number. And then we see the same for offices and industrial. And I think those numbers are quite interesting because you can see, yes, transaction volumes 2024 in the blue bar are lower and significantly lower than the 10-year average for the same periods. That is true for office as well. So office transaction volumes that we measure across the world are probably only half of what they were on average over the last 10 years. But you can also see that global industrial number on the right side in the left chart is actually on par with 10-year averages. Maybe volumes are not as high as they were 2-3 years ago, but on average, we do see that the interest in the sector is on par with its long-term average. And I think that really shows that, yeah, industrial is a sector where people do have a little bit more confidence in at the moment than maybe some of the others, notably office and retail. And to highlight that, on the right, we also have the individual market numbers. So US, UK, France, and Germany, they're in the middle chart. I've used a different axis because otherwise Belgium and Netherlands come out very low. But you can see US slightly below long-term average, UK only marginally, France is even over long-term average, and Germany also probably at 70-80% of long-term average. And then if we look to Belgium and Netherlands, we see Belgium has been relatively active in 2024. And also Netherlands basically in line with what we've seen on the long run. So really, yeah, activity levels are back on where they were on average for that sector, and that's definitely not the case elsewhere. As I said, we've seen these value decreases since June 2022. And what we see here is the yield movements as we measure them. Now, I'm sure Madeline and Petar will show some yields in a second as well. These are the yields as we measure them in the valuations in our indexes. So we get the properties on a quarterly basis, because this is our quarterly index for Europe. And every quarter we get the valuation, we get the market rents, and that's how these yields are calculated. You can see that Netherlands is even bumped up a little bit higher, up to 7% of gross reversionary yield. Belgium actually sits on the bottom there at 6%, but you can really see it's the move outwards that has driven values down. And look, I'd say these yields probably look fairly compelling already again, also given the transaction volumes we just saw. And that's backed up by the rents. So from those valuations, we also gather the rents, and this is rent passing, so it's the actually contracted rent as at each period. And this is the rent passing growth over the last 5 years in the light blue bars, and over the last year in green bars. Now, once again, I mean, I think you can see across Europe, this is very healthy rental growth, right? If not stellar, given that 5%, 6% even in other industrial UK, that is on an annualized basis. So that's every year 6 or 5 or maybe 4.2 in case of a logistics Spain, every year over the last 5 years. And you can see also in green, also there, I think the rent growth is fairly strong. If we zoom in onto Belgium and Netherlands, you can see that Belgium and Netherlands, sorry, you can see that the Netherlands, I should say, is on the right side, meaning that the latest rental growth numbers are maybe a little bit muted. But you can also see that Netherlands has been delivering really quite strong rental growth before that, and so I think the 2.9 and 1.7 should be seen as a normalization. At the other end, we don't have a 5-year annualized number for Belgium just yet, but the Logistics Belgium in our indexes has delivered 8% of rental growth, and that's really quite strong, being second only after other industrial in France. So yeah, this disparity between, on the one hand, the yields pushing values down a little bit, but on the other end, rental growth really being quite strong. That is, I think, the characteristic of the industrial market at the moment, and it does show the strength. Obviously, not entirely immune to the overall economic trend, but still delivering really good rental growth. And if we zoom in onto the leasing, I found this a really interesting chart to give some perspective. Now, this is UK data. And what we do in the UK is we actually monitor what happens within the properties that are in our index. We monitor what happens at the moment that leases end. And so on the left side, you can see for each of the 3 sectors there, at the end of the leases, how many of those leases was actually renewed by the existing tenant. And so, I mean, the line that jumps out straight away, I think, is the office line. So the offices the office sector saw very limited amount of relettings. And I think that's explainable because obviously offices that have been rented out 5 or 10 years ago, even in the UK, because the contracts are a little bit longer there. In many cases, the tenants now have a completely different demand on what they want from offices, and I think that has obviously hit the office market in the sense that before and after COVID, and now working from home, we're working that out, is really impacting those relettings. But at the same time, you can see that retail and industrial are more in the middle, so around half of the leases gets renewed. But then it's really interesting to look at the right side of this chart, because here we can see that the green line shows that in industrial, when leases are relet, they're typically relet at a higher rent, and that really shows the strength, I think, in this sector, because it means that tenants want to stay, and tenants are willing to pay more rent than they paid before to stay in their current premises. Whereas with retail, it's exactly the opposite, where you can see that most leases that are actually renewed are renewed at a lower rent level. Now, just to look into what's happening further in the broader investment markets, I do find this interesting as well, because here we're looking at who's actually buying at the moment. And I think, and this is what the tagline already says, I think we are seeing a lot of buyers that are more either value add focused or are more in the listed space and seeing some opportunity on pricing. And so we don't see a lot of institutional buyers, particularly not on the left side of this chart, which is overall real estate in Europe. You can really see it's the value add opportunistic players that are dominating the list. That's a little bit less the case on industrial, which once again I think shows the strength of the sector. But still, also there, a number of the private equity groups jump out, as does, for example, Segro, a listed player. But I do think the Segro and the Clarion transactions that we see there are probably more core than we see in the overall market, which once again bodes well for that sector. And finally, and I think this is once again a silver lining, we see transaction volumes being muted in the overall market. We see transaction volumes picking up in industrial, but I think this one is important because this shows returns that have been achieved based on their vintage. So on the horizontal axis, you see the years there, and basically what we're showing is the return that has been made on properties bought in that year. So if we start on the left, properties bought in 2006 across all sectors have returned on average 4.5% per annum since. So that is almost 20 years of 4.5% per year. Industrial has done better, 6.2%. And if we take that logic and look across the chart, you can see that actually assets being purchased in 2009 have actually fared best. So looking back, obviously GFC, global financial crisis, hit in 2007, 2008, and basically a year and a half, 2 years later, has turned out the best vintage. And I think that is a strong signal to all of us. If you wait too long, you might miss out on the returns on the long run. So yeah, with that said, I'd like to hand over and thank everyone for their attention, and looking forward to speaking to the panel shortly.
Thank you, Martin. There will be surely lots of questions for you coming from the audience, but we will wait for the discussion panel to answer them. I saw that you looked very, very thoughtfully to your graphs, and I'm sure that he was looking at this and keeping in mind his performance of his assets. So I'm sure it will be nice discussions afterwards. Let's now welcome Madeleine Buys on the stage. Madeleine is head of research at Colliers Amsterdam, and Madeleine will provide us a view on the logistic market in the Netherlands. Madeleine, it's your time.
Thank you, David. I'm very delighted to be here today, and I'm going to share my screen with you all. So I'll talk you through the market in the Netherlands, what the recent developments are, and especially in the occupier market and the investor market. So I'll start with the occupier market. Now, what we see at the moment, that the market conditions are still very tight, although we see the supply increasing a bit, increase in the supply currently, and that's in the third quarter of 2024. There is 8.2 million square meters of industrial and logistics space available. That's an increase of 20% when you compare it to last year. But at the same time, we see it stabilizing compared to the previous quarter. And if you look a bit more back till 2015, you see that supply is almost half of what it was then. So there's a lot less space available. We've seen recently that take-up increased as well. It's an increase of 10% compared to the same period last year. And there was 3.4 million square meters was absorbed in 2024, and that's what I said, a 10% increase. And although take-up has increased a bit, we see the vacancy rate increasing till 2.3% for the whole industrial and logistic markets in the Netherlands, which is still a very low figure. So what we especially see is that the market conditions are tight. There is supply, but there is in general a lack of supply of real of buildings of high quality and that are very sustainable, and that's what tenants are looking for in the Netherlands. So we see a lack of those kind of buildings. That has to do mostly with a lack of new build in the Netherlands. There's a lot of government regulation preventing new industrial and logistical buildings to be built. There's landscape. There's not a lot of land available for those types of buildings. So you see that tenants are really struggling to find good industrial and logistical spaces. And when we dive a bit more into the hotspots in the Netherlands, the different areas, what I've done here is we looked at the supply, then it's for 2023, and we look at the take-up levels. And when we divide the take-up by the supply, you get a market ratio. It's 54% for the Netherlands as a whole. So the take-up was 54% of the total supply that was available. And you can clearly see the different areas within the Netherlands and how they perform. And we see that the market is the most tight in Tilburg, Waalwijk area, and the other part of North Brabant, the province in the south of the Netherlands. And this is an area as well that has quite a bit of problems with nitrogen, for example. So it's really difficult to get a permit there. And you see that has an effect on the market ratio. And on the other hand, we see, for example, Amsterdam and Schiphol, the market is a bit less tight. So there's more space available for possible tenants, with a market ratio of 26% in Amsterdam. Of the Netherlands, and is more in line with the Netherlands. Then I'll take you through the investment volumes. Well, we calculate them also by ourselves, and we use also the MSCI data for that. I have the figures here for the first 3 quarters of this year, and then of course compare it to previous years. We saw an investment volume of 1.7%, billion euros in 2024, and that's a decline of around 10% compared to 2023. And we especially see that the first quarter was quite good. The investment volumes were higher than in 2023, and then in the second and third quarter, we see the sector lagging behind a bit. And what we now see as well is that the industrial logistical sector isn't the biggest sector when looking at investment volumes. It's the residential sector again in the Netherlands. And it was quite for a few years, the industrial and logistical sector. So you see a bit of a change there as well. And of course, what I mentioned before, the lack of new build, nitrogen problems, of course, the higher interest rate, all affect the level of the investment volume in the Netherlands. And therefore, yeah, we see slightly lower volumes. But what we still see is that there is a lot of interest from foreign investors in the Netherlands. Only, around 27% of the investment volume originates in the Netherlands. And when we look at other sectors, we see mostly like 50 or 60% that is based in the Netherlands. So there is still a lot of interest from foreign investors in this sector. Well, of course, it is based on our location with the Port of Rotterdam, the Port of Amsterdam, of course, and our position within the, so-called blue banana. And, well, we see that we have quite a bit of a competitive advantage when looking at the INLs compared to other European countries. And yeah, you see it reflected within the investment volumes still, and the investors that are coming from all over the world. Well, of course, what I just mentioned is that the conditions are a little bit less favorable, and that is reflected in the gross initial yield that we see. It is getting a bit higher, but we see at the current level, it is more stable compared to last year, but it is higher than, for example, in 2021. And of course, well, Maarten talked you through a bit already as well. And to finalize it, you see here the different gross initial yields and prime rents for the different hotspots, the areas within the Netherlands. And of course, you see the areas that are in high demand, where the gross initial yield is a bit lower than, well, the areas that are a bit, that have a bit more availability, for example. And you see the prime rents, and that's a bit of a difference within with the MSCI figures. We look at the prime yields and prime rents. They don't differ that much, but you see, for example, the area Tilburg, Waalwijk, and West-Brabant, the prime rents are a bit lower than, for example, within the Amsterdam and Schiphol area. So this is for us and for the Netherlands a bit of a quick overview of the market. The conditions are a bit less favorable than, for example, a few years ago, but we see a lot of potential still in the market. And I think I give the floor back to you, David.
Thank you, Madeleine. Thank you, therefore. And it was very, very interesting. And I propose to turn directly the floor over to Petar, Timotic, consultant at Colliers Belgium, and specialized in industrial and logistics. And let's maybe compare the situation then in Belgium compared to what have been explained by Madeleine in the Netherlands.
All right, thank you for the kind introduction, David. I mean, it's a pleasure being part of this. First of all, I'm happy as a broker to see the attendance list for this webinar and the interest for the Belgian market. Maybe most of you are here for the Netherlands. In either case, I'm going to take a couple of minutes of your day to present you a couple of data points and insight on the market. First of all, let me start by trying to share my screen. So, an update on the market. The best thing we can do is start by giving you.
It's coming.
You see it?
Here it is.
Okay. Still?
Yeah.
So, how do we start? Start with the market update. We need to start to look at the market. The Belgian logistic market split up into 7 sub-markets, with the main 3 markets being around the major trade infrastructure, the port of Antwerp and the airport of Brussels. Those major 3 markets, that you can see in the middle of the map, currently propose a prime rent of 70 euros per square meter, which can be found in Brussels, but this year also in Antwerp. This is quite interesting to mention. Previously, the prime rent was always in Brussels, and that was by the equation that there's quite a strong land scarcity in the Brussels neighborhood and the Brussels market, and quite strict regulation of providing new stock. Now we did achieve a new prime rent in the city of Antwerp by a project of Montea called the Blue Gate project, close to the port of Antwerp, that has reached the 70 euros per square meter mark, making it a prime rent. And that really indicates that, and that's also to refer to the figures of MSCI, that indicates that store rental growth that we have been seeing in the Belgian logistics market, where a couple of years back we didn't even have a prime rent of 50 euros in Antwerp, and now we talked about 70 euros. Further on, if you go further on the market and look what's behind that, we start to talk about the take-up figures. I mean, we can say quite happily in the Belgian market, we have seen quite strong take-up for logistic properties in Belgium, surpassing the 1 million square meter mark in 2022 and 2023, and really showcasing that on a historic average level, we have seen quite positive take-up. Now, when you look at this graph, you don't really see the positives immediately, but you see, or you look at what's happening in 2024. And we do need to confess that in 2024, these are only the figures of the first 3 quarters. But in 2024, with the focus of the total year, we're expecting to have a decrease in take-up by around 50% compared to 2023. The first question you would have, why are we seeing this decrease? First of all, it's not only something happening in Belgium, it's also happening in other European Western markets. But majorly, when we talk with our agency team, 2 major points that the occupiers and the end users have as argument is that they have been postponing a lot of decision making in 2024, while they couldn't get the right approval for their investments, making that their need for space was a bit lower than in previous years. Secondly, maybe because of the boom in 2022 and 2023, they have had a surplus of space leased in that period, making their need for additions to 2024 a bit lower. Now, those take-up figures also reflect themselves in the vacancy. The current vacancy on the overall market stands at 3.8%. Now, the year still needs to end, but in Q3 2024, we are speaking about a vacancy of 3.8%. Now, which is still on an European level quite low and healthy. If we compare it to our lowest point in 2021, where we only had 80 basis points, it's quite a big increase. Now, I need to mention that those vacancies are quite different from market to market. For example, in Brussels, the vacancy is still almost at 0%. It's 1 point above. While in the market between Antwerp and Brussels, which is the main logistic talk. There, the vacancy has increased quite strongly in the last year, primarily because of the fact that third-party logistic providers have decided to be a bit more cost. On a general level, it's still quite good. So from moving on from the occupier market to the investment market, I'm going to immediately showcase something which a lot of you already know. 2023 was not the best market for investments compared to 2022. In 2022, we reached our record high investment volume, surpassing the 1 billion euro mark. Now, interestingly, for 2024, while other asset classes like offices and retail are still struggling in Belgium, we are seeing that industrial logistics is behaving quite strongly, with already surpassing the investment volume in the first 3 quarters of the year, while we are also expecting that by the end of this year, there are going to be quite some deals being closed, making it quite a good year compared to the average of the last 10 years. Moving forward, and an interesting graph to showcase is the split between the domestic and the foreign investors. The last 2 years, in 2023 and 2022, the primarily capital came from domestic investors. Belgium has quite a variety of strong investment and capital sources in Belgium, which have been quite active in the last 2 years. But it does not mean that foreign capital is not interested. Actually, we constantly see with our discussions with investment funds that they have a strong interest for Belgium because of fundamentals. And that has been showcased in 2024 by now. For example, the first core transaction we have had in the last 2 years was developed by a Belgian developer and was acquired by a foreign investment fund. On the other hand, there are also a couple of value-add and core plus foreign Anglo-Saxons, US, and other European investors also getting their foot into the door in the Belgian market and probably also be more and more active in the coming years. Maybe good to compare with the Netherlands. I think that Madeleine showed a figure where only 25% of the transactions in the Netherlands in 2024 happened by Dutch investors. We are not currently there yet, but we do expect in the future to have more foreign capital and be more comparable to the Netherlands. And then one of the last slides talking about yield and indications in terms of where yields have moved and will move. The last 1.5 years, we primarily said that the prime yield in Belgium for logistics at 5%. There's no real market evidence for that because it hasn't happened a core transaction, but there is really there's a sentiment and a conviction in the market 5% prime yield Belgian logistics. We do need to emphasize that when we currently talk with institutional capital for the coming year, that they are indicated that they are able to go below 5%, indicating that a yield of 4.5% net initial for post profit value is something that they are already capable to do, and with maybe even more rate because more positive news on financial within the capital market, that could indicate even sharper yields for Belgian logistics, which would be in line with what we expect for the market. So, in general, I'm going to stop sharing my screen.
Thank you, Petar. Very, very interesting. And once again, I think that you has here to your expectations on yields, and I'm will be very pleased to hear you about that. But there will be lots of questions. Once again, we will answer these questions in the discussion panel a little bit later. Ladies and gentlemen, now I have the great pleasure to introduce you, Jo de Wolf, CEO of Montea, for almost 15 years, I think. If my information is correct. Jo, we are very interested to hear about Montea. What is Montea today? What are the challenges and what is your strategy for the future? Jo, the floor is yours.
Thank you very much for the invitation, David, and thank you all for joining. I will share my screen. I hope you can see it. I made a small introduction, only 5 minutes, on who we are and where we come from. Basically, Montea has been the life achievement of Pierre de Pauw, one of two brothers who started already in the 60s by demolishing all industrial sites in Belgium and redeveloping them in the first logistic buildings. We've had our IPO in 2006, which is now 18 years ago. And since the IPO of 100 million at the time, we grew the portfolio to 2.5 billion today. And that growth in the first 10 years, I would say, came from standing investments. By now, we've developed in all of the countries where we're active, and that's Belgium, Holland, France, and Germany. We have developed our own in-house development teams. We have developed our own land bank. So over the last 8 years, I would say the growth mainly came from in-house developments. This is where the portfolio is today. It's already been mentioned by Madeleine and by Petar that indeed in Belgium, this is the typical axe Brussels Antwerp. That is, of course, the main target. In Amsterdam, in Holland, we have the corridor between Amsterdam, Rotterdam, Breda towards Venlo. That is our main target. And in France, of course, that is the La Fameuse Dorsale, Lille, Paris, Lyon, Marseille, where all the assets are situated. And we are just a startup in Germany. But today we have a portfolio of roughly 2 million square meters. And as you see, we have a 99.9% occupancy rate. And based on an initial yield of 5.1%, today we have a portfolio of roughly 2.2 billion euros plus a land bank of 300 million. As you see, we have always focused on prime locations. We never gave in on that first and most important criterion. We all know it in real estate. And that's why basically we've been able to increase our earnings per share over the last 5 years, and I repeat it by share, per share, with 66%, and the net asset value, so the underlying value of the assets in the portfolio over that same period, even increased by 124%. With those values, Montea has been the strongest performer of all real estate shares in Belgium over the last 5 years and has been top 3 in Europe. So quite a good performance, and we're proud of it. Now, we recently launched a new growth plan, which basically also means that we keep believing in this sector. We have a portfolio, including the land bank, of 2.5 billion today. That was 2.3 million at the end of 23. And we want to increase that by 1.2 billion by the end of 27. So that's a 50% growth of the portfolio in 4 years. And we want to increase the earnings per share over that same period by 25%. So we remain very ambitious. Also on sustainability, we keep our ambitions high. We want to reduce our greenhouse gas emissions by 45% by the end of 27. All our new developments are zero emission buildings. Basically, we are able to produce more energy on our roofs than what is used in our buildings. So basically, they are energy positive. We want to continue that path by investing at least 75 million in additional solar panels and battery energy storage. Sustainable pillars of growth. There's one I would like to talk about, and this is really the cornerstone of our growth strategy, is that since many years, 8 years now, we have been focusing on building a land bank. So basically, today we have 2.7 million square meters of land, zoned land, under control, and this will fuel the continued growth of the portfolio. If I look, for example, of the 2.7 million, we want to bring in the next 2 years roughly 1 million square meters into development. That's 600,000 square meters GLA, and we can do that at an average yield on cost, so the land cost plus the construction cost. And we take the new ERVs that I fully support, as they were mentioned by Madeleine and Petar. So basically, we are able to achieve a yield on cost of 7%. So all of these projects are accretive for our earnings per share. This being said, I absolutely agree that we see a slowdown. If those permits would have been in place 2 years ago, everything would have been signed and built within a year. Today, we see that over the last 9 months, we were only able to sign up to 40 to 50,000 square meters. So basically, there are candidates for every building. It's not about price negotiation because, as Madeleine said, there is no alternative. There's only very limited offer available. So it's not about pricing, but it's really about, I would call it procrastination, and trying to wait another month, another 3 months to take the decision. So absolutely true. Here you see those beautiful projects in Belgium. Approximately half of them are under construction today. And in Holland, where 2 out of 3 are also under construction. Just want to end with a recent transaction we did in the summer. We basically bought 17, I would call them parking lots of Jackie Perrenot, which is a French transport company. It's mainly, I would say, parkings, as you can see here, with a very small building on it, mainly parking. Why do we buy these kind of buildings? Well, basically, we're not buying the building, we're buying the land. We're buying in total 650,000 square meters of land, only 80,000 square meter GLA on it. And this is a 10-year lease. And in 10 years, well, we'll see. We are convinced that land will only become more scarce. So we buy it today. We have a nice return as an investor today, but we see the upward potential in the future for redevelopment, since we believe that land will only become more scarce. So this yielding land bank is really the cornerstone of our growth strategy, and that's why I wanted to really point that out as something that is really crucial for the development and the future growth of Montea. Thank you very much.
Thank you, Jo. Thank you for your presentation. I propose now to move to the discussion panel, where we will dive into some of the hot topics and emerging questions in today's market. And it's a great opportunity to then share with all of you the perspective and tackle some key challenges we are all facing. Maybe a first question to you, Jo, if you allow me. As one of a very active player in this region, we are speaking about Belgium and the Netherlands. How do you see the competitiveness of this market? How do you see the attractiveness of Belgium and the Netherlands in comparison with other markets where you are active, or other European markets maybe that you are analyzing at the moment?
Well, if we look at global players, when they enter Europe, they only look at 3 markets. It's the UK, France, and Germany, because these are 3 liquid markets where there's enough demand and offer, so they can step in. Where I've heard it so many times, Belgium, it's a bit like the small village of Asterix, where it's impossible to get in because everything is already distributed between the home players. But I think it is a great market to invest in. Let's not forget that for logistics, this is the gateway to Europe. More than 50% of all containers entering Europe come via the ports of Antwerp, Rotterdam, Amsterdam, and the demand for space to handle these containers is therefore, in my opinion, guaranteed. This being said, these ports are situated in one of the most densely populated areas in Europe. So the Randstad of Antwerp, of Holland, Amsterdam, Rotterdam, The Hague, Utrecht, but also the Golden Triangle in Belgium are highly populated. So there's very limited new offer of available land, and there's no view that there will be more land available. So as an investor, personally, I would always prefer to invest in markets where demand is guaranteed, and the gateway to Europe, but on the other side where the offer remains very scarce. And given the combinations of the guaranteed container transport and the scarcity of land available, I think this is a very interesting market, but it's a very deep market to go in. You really need to have boots on the ground in order to be able to penetrate the market.
So if I understand you good, land scarcity in our countries is not always a bad situation. It provides a certain security on the value of your asset, but in the meantime, you are creating a quite important land bank in France, and I suppose also in Germany. So you have to expand and looking for new possibility.
Yeah, absolutely.
Yeah. Perfect. Well, if I come back to you also, you for another question, and that you have mentioned. How do you differentiate today between the acquisition for development asset versus standing investment? Can we say that the profile of your company is changing, is going to change in the future in a more developer than investor?
Well, it's funny that you mentioned that, because if you look back 15 years ago when I started, it was very clear. You had people like Montea that were pure investors, and then you had developers. What we see is that a lot of those developers, let's take VGP as an example, has also become an investor. They now have GVs with Allianz and with Deka. And a lot of the pure investors have also become developers. So I would say that it's much less clear what the different profiles are. For us, it's clear that if we want to have the full control over the quality and we want to have the added value for our shareholders, we need to really be very early in the cycle and really develop that land bank. This being said, and this is from a study of Green Street, a study from 23. We are also active in the countries where there's the lowest rate of speculative development. For every 100,000 square meters of demand in the market or take up in the market, there's only 60,000 square meters of speculative development in France, in Germany, and in Holland, and only 30,000 in Belgium. So there is absolutely no risk, and I can't repeat this enough, there is no risk of oversupply in our market. And I fully agree with what Madeleine said, that, and this is something we also saw in 2011, when they said, yes, vacancy rates in Holland are high, but when you go into detail, you see that it's B product on C locations that has maybe vacancy rates of 30%. But the core product on prime locations, and you see it in our vacancy rate, it's 0.1%. The prime product on good locations, there is no vacancy. So I truly believe that for our core markets, definitely given the expected continued growth of the e-commerce sector, and where we only have today a penetration of 14%, 1/4. So of all retail sales in the Benelux and France, only 14% is done via e-commerce, where in the UK, the US, this is more like 28 to 30%. So there's a huge growth still ahead of us. And that's why I'm absolutely convinced that the demand for our sector is more than secured.
So what you tell us is that the risk profile of your company is not definitely changing. You're adapting to the market conditions and also developing new construction, but the risk profile remains quite low in this market, in these regions.
Absolutely.
Thank you. Maybe a question to you, Martin. Thank you for it. Was very interesting, but based on the market data that you showed us, how does MSCI assess the investment attractiveness of industrial and logistics, maybe compared to other asset classes such as office and retail? And we heard from Adeline that residential also is quite still very interesting in the Netherlands or attractive. So how do you assess that attractivity in industrial and logistics at the moment?
Yeah, thank you, David. I mean, what we see, I mean, we're not in the business of forecasting returns, but what we see, obviously, that because of the interest rate environment changing, I think investors are adjusting their expectations on having value growth by yield compression. And I mean, look, we can discuss a long time on whether yields are going to compress or whether they're going to be staying the same, but I think everyone will agree that the zero interest rate days are probably over. And that means there's a refocus on income, right? Because if you want to have proper returns going forward, you will have to generate income growth. And then if you look to the industrial sector, and I just showed a few of those charts, yeah, the industrial sector has proven to be able to generate pretty good income growth. Also, if we look to market rents in relation to actual rents, we see there's still a gap there, and I mean all the stories just told seem to indicate quite strongly that once those leases are up, there will be reversion taking place, and that excess rent growth will be there. I mean, some sectors are looking better than others. I mean, also because of time, I don't want to go into the other sectors, but I think it's that income profile which investors are very keen on, and I think that income profile seems to work quite well for the industrial sector.
Yeah, and the stability of the tenants, as you showed in the lease renewal, was very positive for in the industrial and logistics sector, which in the office asset for the office asset class at the moment is a little bit more difficult.
Yeah, I mean,
reduction of
Yo basically said they don't have a choice than to come to us, and those numbers underpin that.
Maybe then a question to the team and maybe the Colliers team, and maybe also for you, only good news and positive trends on the logistic and industrial, but we have this take-up data in 24. Maybe a question to you, Petar, and afterwards maybe for Madeleine, but how do you anticipate this positive trend in occupancy? And maybe let's start with the ladies. Madeleine, do you have a view on the evolution of the occupation trend in the Netherlands?
Yes. What we expect is that there will be, and we see it already a bit now, but we expect slow but stable growth for occupancy. Of course, we see less economic growth that has an impact, and we see, for example, still see growth in e-commerce, but the growth rate is not that high as a few years ago. But what I mentioned earlier and what Jo mentioned also as well, we see a mismatch between supply and demand. So there isn't that much good, high quality, very sustainable supply. So yeah, the outlook is quite positive.
Petar, do you have there a view on that?
So that the recovery of the take-up in 2024 and 2025 will be there. We're quite convinced of that in the Colliers Netherlands. The only thing that I would emphasize, we think it will come back in the short term more than mid-term, primarily because of the fact that, as we mentioned by a couple of people on the panel, most of the end users are postponing their are a bit hesitant about signing new lease contracts. And we have the feeling that there's a bit more certainty in the current market, or there will come more certainty in the current market that will push them to sign it. You can only postpone at a certain level, and that postponement and our current positive estimation will be by the end of the coming quarter.
I see that we are narrowing the end of the webinar, but maybe a question for you, Jo. We haven't spoken about last mile or final mile. Will that have an impact in the near future on your strategy and maybe on the activity in the market? Will be that the recovery of the take-up?
Well, let's put it that way. Logistics has always been pushed to the cheapest land. when a city was growing, we were always pushed to the boundaries where the land was cheap. Today, with last mile, we are getting back into the city because somebody has to organize it. And we did it, for example, for DHL at 3 kilometers from the Cathedral of Antwerp. We did a last mile hub and due to that, we can now do all the delivery in the city with cargo bikes and no longer with vans. So that's great. And it's definitely happening. It's, for example, the main reason why we did this portfolio in France. As I said, when I started 15 years ago, 85% of all logistics in France was on the famous dorsal, Lille, Paris, Lyon, Marseille. 85%. Of course, today, with major cities like Bordeaux, like Toulouse, like Nantes, like Rennes, that are not on La Dorsale, but that are at the Atlantic Arc, as we call it now. Of course, they also need 24-hour deliveries. So basically, you will need those regional hubs in, let's call them secondary cities, in order to deliver on the promise of next day delivery. So absolutely, we see markets where 15 years ago we would have not been interested in are becoming interesting just due to that the requirements of the last mile delivery. Absolutely.
Thank you. Well, I think we have to terminate this exciting and interesting discussion now. I thank you all for your participation, the panel, Madeleine, Martin, Petar, Jo, but all of you to attend our webinar. I can conclude that there is certainly some bright future for the logistic and industrial sector, that there are some challenges for sure. We are navigating in troubled time, that's for sure. There is a financial crisis behind us, let's hope, but there will be some interesting topics for the future in the industrial and logistic sector. Maybe there are still quite a lot of questions that we haven't answered. Please don't hesitate to take contact with Colliers, and we will put you in contact with the good persons to answer the question with pleasure. I have to thank you, all of you, for your participation. Sorry for 2 minutes delay, but it was very, very interesting to hear all of us. Thank you, and I wish you all the best. And it's a little bit early, but Merry Christmas for those I will not see before. See you.
Thanks.
Thank you.
Bye.
Bye everyone.